Hi, dreamers. I've been really busy this week, so today's going to be more off the cuff. And I know I should be thinking about my channel in terms of popular topics, clicks, and all the like. But nah, I'm just going to record what I'm thinking about. And what I'm thinking about right now is where are we going in terms of this entire economy? Because we've had a big announcement this week with the interest rate cut of 50 basis points. Wow. So what does that mean? And how should we be thinking about that in terms of our investments? Well, I wanted to show you this graph that's actually available to everybody inside of Fidelity, and I'll include a link in the description. But essentially what this shows here is the business cycle update as of the third quarter of 2024. So this is not just a general graph, this is an actual graph of where we are in the cycle dynamics, which if you've been an investor for a long time, you've seen this cycle repeat itself over and over. And so as you can see here, we have early, mid, and late stage in terms of economic growth, followed by a recessionary period, which then loops around to an early stage growth, a mid, and a late stage. And here you can see the different countries in the different stages that they are in. And what's cool about this is you can actually click on a particular geographic region, like the United States, and actually see from a time perspective that in Q3 we were still in the mid to late expansionary phase in 2023. But actually, if you look overseas into places like the United Kingdom, you can see that they are already into recession. And you may have seen headlines about the United Kingdom and other places like Canada way ahead of us in terms of cutting their interest rates. And I do have some folks watching from Australia, so it looks like they are late stage as well. And so as we think about this in whole, we start to prepare ourselves for a little bit of a different experience as we head into a recessionary time period. And I know. You've seen headlines of recession is coming for over a year now, and so you may be thinking, oh, we're just going to avoid it. And from my perspective, that's not the case. We just haven't gotten to the depth of the trough yet. So there's another place in Fidelity where it talks about what typically happens. And now I'm talking about historical performance of sectors during certain business cycle phases. And so let's take a look at this graph on the right-hand side, and you can see that while different time frames have their own unique dynamics, these are generally how sectors perform in the different stages of the business cycle. And so as you recall, the United States is starting to enter into late growth, early recession phases. And so in the mid phase, you would expect to see information technology doing well, and things like communication services. And so let's take a look at year to date. And wouldn't you know it, the top sector performance is from the infotech and the communication services. But as we go into the late growth cycle, you might expect to see things like real estate, consumer staples, energy, and utilities do well. So if we look at the performance, let's say for the last 3 months, all of a sudden that starts to switch up. We've got real estate on top, utilities, financials, industrials, and consumer discretionary. And then if we look at the past month, we've got conflicting signals of consumer discretionary still high, but that real estate, industrial, and utilities. So what I think is interesting about this, and what I'm trying to point out, is that the typical performance of the late stage sectors is starting to play out in the last few months. And so if you're into ice hockey, you might think about where is the puck going instead of where it's been. And so if we're heading into a recessionary phase, whether that be deep or a soft landing, we will expect to see consumer staples, healthcare, and utilities doing well in a time frame like this. And so you may be saying, Dream, I guess I understand that, but what do I do with that kind of information? Well, here's something that you might do with that kind of information. If you knew that utilities, let's say, were about to get a rebound, you might go down to, say, the utilities sector and take a look at this particular sector. And inside of here, you might notice that there's actually a few different industries inside the sector: electric, gas, independent power and renewable, multi-utilities, and water. And so here you might start to sort for what has performed over the last 10 years. Looks like electricity. What about year to date? Electricity again. And so let's say you decided, okay, I want to pick one stock from the electricity utilities industry to take a look at and maybe put some additional funds in just over the next few months. What you might do is take a look at the stock screener, and then in the sector, industry, and sub-industry, open this up, remove everything but the electric utilities, and maybe you just want to look at the big companies, because a lot of these are really small or micro caps. And so let's say you just say, I want to look at mega caps and large caps. And so here you have a nice, neat little list. And you can start to look at the basic facts, like what's the dividend yield and what's the company location. And so you might come across things like Duke, Southern Company, and Nextra Energy. And you can also see if they're optionable as well. And so you might at that point say, well, what's the PE of these currently? And sort by that. And so here we see that Duke, for example, has a 20 PE, which is pretty good. And if we go into analyst opinions, we can see it's rated a buy. Now, you know I always want to go to Seeking Alpha and take a look at what they have on Duke as well. And so here we can see good ratings for dividend safety, growth, etc. Payout ratio of 67%, 12 years dividend growth, and a pretty average dividend yield. And so, I know not everybody has a Fidelity account, but I do know that most brokerages have sector analysis like this, and the ability to drill down and take a look at what companies start to pop up. But there's another way you can play this as well. If you agree that we're about to enter a late growth or maybe even a short recessionary period, hopefully a short, then another way to play it is simply to buy the entire sector and not have to hunt and peck and do all that research for individual companies. And so one way I'm playing this is buying some additional VNQ for the real estate sector, or XLRE. I've bought some XLU, which is the whole utilities sector. I already have a pretty significant financial basket, so I'm good there. And I'm also thinking ahead and focusing in on the healthcare sector. And so I've recently bought some XLV. And these are not major rotations for me, but rather as dividends come up and pay out, I'm putting them towards some of these sectors. And one other way you can play this is to have a defensive posture, whether that be in cash or what I recently did in amassing over 3,000 shares of PDI. But another way is to think about broadening your exposure if you're a little heavy in infotech. So things like JQUA, Devo, and even some of those broader derivative ETFs that I've been covering in dedicated videos like SPY-I, QQQI, and JPIX, which will help stabilize your return in a down or sideways market. So I hope that was helpful for you as you think about continuing to diversify your portfolio and maybe getting ready a little more for the next few months as we head into another kind of business cycle. And the last thing I'll leave you with is if you're a long-term investor and you have your portfolio balanced the way you want it, or are simply investing broadly in ETFs, that's perfectly fine, because then you're only worried about the next 5, 10, 15, or 20 years, and you're thinking way beyond these 18 to 24 month cycles. Let me know what you think in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.